My name's Ethan Braid. Today we're going to look at how much you can safely spend off a $1 million retirement portfolio using actual results over the last 25 years from several of the most popular Fidelity and Vanguard retirement funds. First, I'm going to quickly walk you through what these funds are. Then we're going to take a look at several different spending strategies, 5%, 4%, 3%, and see how these funds compared over the last 25 years, a typical retirement. You're going to want to stay with me. I think you'll find the results to be shocking. We're going to compare 4 funds today. The first fund will be the Vanguard Balanced Index Fund. This is a moderate allocation mutual fund with a low expense ratio of 0.18%. The Vanguard Balanced Index Fund has just over 60% of its holdings in the stock market and the rest in bonds and cash. The fund has 70% of the holdings in large and giant capitalization stocks, about 20% in mid-cap, and the remainder in small and micro-cap. The second fund will be the Fidelity Balance Fund, also a moderate allocation fund with a higher expense ratio at 0.51%. The Fidelity Balance Fund has an asset allocation that's similar to Vanguard with 62% in the stock market and the remainder in bonds and cash, but there is a difference when it comes to market capitalization. The Fidelity Balance Fund has approximately 80% in large and giant capitalization stocks, almost 16 in mid-cap, and a lot less in small and micro than Vanguard. Keep those subtle differences between Fidelity Balanced and Vanguard Balanced in mind later on when we go through the results of this presentation. Those little differences can add up to huge dollars over time, and you're going to see that here in a little bit. What's really intriguing is both of these funds are labeled as moderate allocation funds. They're doing the same thing, and they both have essentially the same asset allocation at 60-40, but the long-term results are very, very different. The third fund will be the Vanguard Total Bond Market Index, an intermediate core bond fund with a low expense ratio at 0.15%. The Vanguard Total Bond Market Index has 100% of the fund's assets in bonds, with 26% in corporate, 49% government, the rest in securitized municipal and cash. The fourth fund will be the Fidelity US Bond Index, also an intermediate core bond fund with an extremely low expense ratio at 0.02%. The Fidelity US Bond Index has 100% of the assets in bonds, 26% corporate, 43% government, the rest in securitized municipal and cash. Our first illustration will use a 5% retirement spending rate grown by 3% inflation. We're going to make a $1 million investment in all 4 funds on January 1 of the year 2000, 25 distribution years ago. Let's see the results. First in the lineup is the Vanguard Balanced Index Fund. Sad to say, but after 23 years, this fund ran out of money if a retiree was spending 5% per year and growing that 5% distribution by 3% for inflation. Next, we have the Fidelity Balance Fund. Everything the same. Starting January 1, 2000 with $1 million, withdrawing 5% every year, growing that 5% by 3% for inflation. But what a difference for a retiree who used the Fidelity Balance Fund versus the Vanguard Balance Fund. For this retiree, they still have $1 million in their portfolio all these years later. For the retiree who thought using an all bond portfolio for their retirement would be safe, it's turned out to be not so safe. This is the Vanguard Total Bond Market Index. We're making a $1 million investment in the year 2000. We're distributing 5%, growing it for inflation every year, and we are almost out of money after 25 distributions. The Fidelity Bond Market Index Fund ended up in almost the same place as Vanguard. This fund was just slightly ahead, finishing with $111,000 after 25 distributions versus Vanguard at $85,000. The most obvious takeaway from this data is that spending 5% in retirement and growing your spending by 3% for inflation is going to be a tall order for many of the most popular retirement investments, and you may very well run out of money. The second takeaway is that if you plan to spend 5% in retirement and grow it for inflation, investment selection really matters. The Vanguard Balance Fund and the Fidelity Balance Fund do the same thing. They're both 60-40 asset allocation funds, and the Vanguard Fund is much cheaper. but the end results were very different. With one fund, you ran out of money, and with the other fund, you still have what you started with after 25 years of distributions. Now let's take a look at 4% retirement spending grown for inflation. Here is what happens when you decrease your spending from 5% to 4%. This is the Vanguard Balanced Index Fund. We're making $1 million investment in the year 2000. We're taking 4% in the first year and then growing that 4% by 3% inflation every year thereafter for a total of 25 distributions. And we end after all these years with $673,750. Here are the results for the Fidelity Balanced Fund. Really exciting to see this. This fund is now worth $2.1 million after 25 years of distributions, starting with 4% in the first year and growing the distribution by 3% inflation every year thereafter. 4% inflation-adjusted spending for an all-bond portfolio over the last 25 years of distributions worked out. This is the Vanguard Total Bond Market Index Fund. After 25 years of distributions, there's still $555,000 left in the portfolio. However, I would point out that the fund is rapidly declining in value. If you're a person who's planning on a longer retirement or you have longevity in your family, you may want to be careful with the 4% inflation-adjusted spending strategy because you may run out of money before your retirement is over if you're using an all-bond strategy. Here's a look at 4% inflation-adjusted spending with the Fidelity U.S. Bond Index Fund. Almost the same ending value as Vanguard. Fidelity slightly ahead at $584,000. Our takeaways for the 4% inflation-adjusted spending illustrations across these four funds are that 1, if you spend 4% versus 5%, you're a lot more likely to succeed. You have more margin for error. 2, bonds are likely to eventually run out of money because they don't have any inflation protection in them. There's no growth component with bonds. So if you live long enough and you're spending 4% inflation adjusted and you're using an all bond portfolio, there's a very good chance that you're going to run out of money. Our third takeaway is that investment selection and asset allocation are still important at the 4% inflation adjusted spending level. In 3 out of 4 of these illustrations, you had less money after 25 years of distributions than you started with. Only one, the Fidelity Balance Fund, did you grow your principal throughout your retirement. Now let's see how these illustrations change when we spend 3% inflation adjusted. At the 3% inflation adjusted spending level, even a mediocre fund like the Vanguard Balanced Index Fund has room to breathe, and we finish at $1.6 million after 25 years of distributions. 3% inflation adjusted spending for Fidelity Balance Fund ends in a huge growth of your principal throughout 25 years of distributions. Here we are with $1 million, finishing at $3.2 million, outstanding growth over your retirement. Here's a look at 3% inflation-adjusted spending for the Vanguard Total Bond Market Index Fund. After 25 years, you're right back where you started at $1 million. Encouraging to see. The fund actually went up for most of the last 25 years, and that is because interest rates were declining. Remember, bond prices move opposite to interest rates. So when rates go down, bond prices go up and vice versa. And that is why we see this big drop in the last couple of years, because interest rates have been going up and the fund's value has been going down. 3% inflation-adjusted spending with the Fidelity U.S. Bond Index had a similar result to Vanguard, but you were 10% higher than Vanguard, finishing with $1.1 million versus $1 million. Okay, big takeaways for 3% inflation-adjusted spending. 1, it's hard to screw up. You have a lot more flexibility for making a mistake when it comes to asset allocation or investment selection. 2, there's a very good chance that you could grow the value of your principal throughout your retirement and enhance your security in retirement and have a legacy to leave to your beneficiaries. Now I'm going to take you through a data table so you can see the numbers behind those graphs. Anybody can make a graph, right? Trust but verify. I'm going to quickly take you through a data table for the 5% spending strategy so you can see the numbers behind some of these graphs. Here are the numbers for the Vanguard Balanced Index Fund using the 5% inflation-adjusted spending strategy. We start January 1, 2000 with $1 million investment. We take $50,000 out, 5%. Then we grow that 5% distribution by 3% for inflation every single year of the illustration. After 23 years, in the year 2022, we take our final distribution and we exhaust the fund. We run out of money. This is the data table for the Fidelity Balance Fund 5% inflation adjusted spending strategy. January 1, 2000, $1 million investment, $50,000, growing up by 3% for inflation. But as we know, the end result is very different. Here we are in the year 2024. We take our January distribution of $101,640. And at the end of February, we have $1,026,145 still in our retirement account. This is the data table for the Vanguard Total Bond Market Index Fund. January of 2000, put in $1 million, take out our first $50,000, grow it by 3% for inflation. Here we are in 2024. We take our 25th distribution on 101,640, and the fund's value is at $85,047. Here's the data for the 5% inflation adjusted spending strategy using the Fidelity Bond Index. $1 million investment, January 1, 2000, take out $50,000, grow that distribution by 3%, and we finish in February of 2024 with $111,000. Retirement planning requires expertise and experience. I think in today's environment, many people are over-reliant upon financial planning software, and financial planning software can get you into trouble very fast. It's easy to make a mistake. If your current advisor has never been through a serious downturn like 2001 or 2008, they may not be equipped to guide you through the next recession, and it is coming. It's only a matter of time. The business cycle is real. So I hope this video gets you thinking. I hope it helps you better analyze your investments and overall improve your family's financial plan.